Hey guys, Whitney here. Welcome to the Passive Investing Made Simple show. I'm your host, Whitney Elkins-Hutten, Director of Investor Education here at PassiveInvesting.com. And I'm excited you have joined me today to learn about how we've turned a deal around. But before we launch into today's topic and bring in our guest of honor here, I just want you to make sure that you have found passiveinvestingwithwhitney.com. There you can register, you can see all of our open deals. You can also get more information about our master classes and our boot camps, classes like these, because we do these webinars live every Tuesday to help you learn the ins and outs of passive investing. And so if you haven't done so already, again, join at passiveinvestingwithwhitney.com. Now, I am so excited. Today, I am joined by one of our managing partners, Danny Randazzo. Danny, as perfect timing, welcome to the show.
Great. Thank you so much for having me on, Whitney.
Yes, yes. Now, Danny, I'm going to give you a second here to a chance to introduce yourself, but I just wanted to let everybody know today we are breaking away from what we usually do. No boring PowerPoint presentations today. Today is where we are going to talk about how we turned one of our multifamily deals around. What does that mean to you as an investor? And we're going to dive deep into a couple of the strategies that we used in order to be successful in this endeavor. So it doesn't matter whether you're an active investor or a passive investor, you're going to want to stay tuned until the very end here. Now, before we get started, Danny, everybody knows, I think everybody knows who you are, but what I want to know is how did you get started in real estate? How did you get launched on this journey and become one of the managing partners at PassiveInvesting.com?
Well, when I was a young boy in the neighborhood, I grew up in Michigan, and I would mow lawns in the summer, clean up people's beaches, move wheelbarrows full of sand. And in the winter, when it was cold, I would shovel driveways and clean sidewalks. And um, I had a bunch of different odd jobs. I would paint, I would fix irrigation systems, you name it, I did it, and would just figure out a way to do it. And then probably by the time I was in middle school, I was very interested in investing books. And so I would read books about Warren Buffett. I would read books about commercial real estate investing. And then into high school, started to take that a little bit more seriously. I took every finance class, all two that my high school had, and then I created a third and fourth class for the high school that they actually implemented and other kids could take. And so I really got interested into investing, and I kind of learned early on through manual labor that it's really hard to earn a dollar, and people work very hard to earn a good living, and you have to work really hard to then save money each month and manage your income and expenses and put money into the bank account each month. And so did that. Funny little side note, with our high school hockey coach, he made us write a summary of what we would do after we graduated high school. And I wrote down that I would buy 10 rental properties on the Michigan State University campus and just rent out those 10 units. And I'd be making $10,000 a month in income, and I'd retire and be happy. And I kind of did that, and then kind of kept going. So fast forward through those years, learned a ton in financial consulting. Also learned how I wouldn't want to be in corporate America and travel a bunch and have a family at home that I would never see. And so started buying rental real estate to generate cash flow, and got focused into that. And then, kind of here's where we are today. And it's been through hard work, one property at a time, one investment at a time, one capital allocation at a time, and just trying to work hard and make good decisions every day.
Mm. Well, I want to segue into what we're talking about today because you mentioned, through hard work, and the last couple years, it's been no secret that it's been very hard for really everyone. No matter if you're like investing in real estate or investing in the stock market, it's been a bumpy ride with the, rise of interest rates, inflation, and that's really, kind of wreaked some havoc on rental real estate. Now, it's really, what do people do with that, right? What do operators do with that? Okay, you can be posed with a challenge, but what do you do? How do you rise to the challenge? Are you going to just hand the keys back over to the bank? Are you going to roll up your sleeves and do the work? And so I wanted to talk about one of our properties, Mariner Grove, as a case study. Would you indulge
Yep.
me in that?
Sure. Let's do it.
Okay, perfect. Okay, so let's just kind of kick it off. Like, Mariner Grove, let's talk about Mariner Grove. What were some of the challenges here and how did they precipitate? What led to the struggles? And, moreover, I want to know what led you as an operator to like double down and say, hey, this is a property, even in today's market, that's worth turning around.
Yeah, so I think in order to understand where we're at now, you have to kind of go back. Buying this property about 2.5 years ago, it was still pretty early in the um, uncertain economic times. People were still buying deals. Um, Interest rates were still lower than where they are today, albeit they were, starting to creep up at that point in time. And so it was still a sound investment opportunity. One of the kind of guiding fundamentals as I think back to some of those commercial real estate investing books is the importance of timing. And the benefit to real estate is, as an operator, if you can control when you sell, that makes the world of difference to a positive return or a negative return. And so, buying the property about 2.5 years ago, we've been presented with a very unique kind of economic condition with some of the post-COVID um, financial easing measures, some of the rent funding programs that were out there, and then you had some of the negative pressures of, inflation really starting to creep out of control from, you know, 2022 to today. And you also had interest rates starting to kind of creep out of control as well. And then, it presented a factor of challenges with real estate, and specifically, this property is located in the Savannah submarket. Um, and so, we had these specific challenges, and we're about halfway through our original 5-year hold period. And so, we never projected to sell early, and we didn't intend to, sell at this point in time. And so we had to figure out a solution to extend our loan and kind of get us into a better, more positive economic climate to sell into at some point in the future. And so, being that we're about halfway through the hold, we knew that the underlying fundamentals of this asset were still very opportunistic. We were able to have a well-built asset in a very good resident demographic submarket, in a community where folks want to live. And we just needed to kind of figure out a couple of the obstacles that we had. One was, additional supply was brought into the submarket. Um, those properties have since been leased up and stabilized. And so our direct competition set has been alleviated just through time. And I think that's one of the things that, as multifamily operators, over the last 5 years, if you look back, the demand for multifamily housing was really rising rapidly. And you were able to just push rents and get them filled up very quickly. And then once people, encountered inflation and groceries are more expensive, they are not moving as much because they're uncertain if they have to go back to the office or if they can stay where they're at. So some of those fundamentals just kind of challenged us as operators. And, the only defense mechanism you have is just to be patient and wait, for the competing property to fill up. There's plenty of people still moving to our geographies and specifically to Savannah. Great job growth, great economic growth. And so you have to be patient with some of those things. And then, the second thing that was a challenge, some of these new competitors, they have nicer finishes, they have nicer common areas. So we had to wait to feel out what the market was going to do. And now that we feel like things are stabilized, we can start to implement and spend money improving the asset, improving some of these common area amenities, improving some of the unit features and functions where we can start to push rents now. Before, again, it was very defensive of, we just want to maintain our occupancy. We want to keep people paying monthly rent, and we can't really push too hard on growing rents. But nowadays, we can start to do that, and we've implemented those pieces. And so we're trending in the positive direction. I wouldn't say that we have miraculously changed the value or doubled it overnight. I don't think us as operators have as much influence. We can grow the NOI, manage expenses. We still need the Fed to kind of go through their planned rate cuts over the next 6 to 12 months. And, hopefully with a reduction in interest rates, we will see the prices that buyers are willing to pay go up, and that'll be a nice positive force as we get into 2025 and into 2026. And so with that patience part, we figured out the supply. We've kind of figured out where we can strategically add value, and the third piece, the most important function, is not being forced to sell. And so having a great relationship with our lender was a huge benefit at this property, and working out an extension for a 2-year period of time was a huge win for us, where we weren't forced to sell at a discount or at a loss because the market is bad. It's kind of like, if an investor opens their stock portfolio and all of a sudden there's red numbers on the screen, are you just going to sell because it's red? Or do you believe in the business or the stock or the real estate, and you believe in it because of the fundamentals that it has, that you're willing to, what's the stock term? Cost value your share. I don't invest in stocks nearly enough. Dollar cost averaging, that's what it is. So you bought the stock at 100, it's worth $80 today. Are you going to buy back in because you believe in the company? Or are you gambling? And, we believe in each one of these projects that we do, and specifically Mariner Grove has some great economic fundamentals where, we just need a little bit more time to get into a better economic condition. So hopefully, I know I went on probably a little bit longer than you wanted, but I kind of hit the three big points. Number one, it was supply. Number two, now it's about improving the financials, improving the net operating income. And then number three, we had to buy time to extend our loan and not be in a position to sell early just because, you open your stock portfolio and you see a little bit of red. It just, let's remain calm. Let's get through these uncertain periods and advance into the future.
Mm. No, and thank you for that. So, just to sound it back, really the money or the stability of the project was proven on the buy side, right? By buying right. We did buy in a right market. We bought a high quality project. There's market forces that are beyond the operator's control. In this case, we're the operator, right? Now, and thank you for going through those three bullet points. I want to peel back the curtain a little bit, right? And kind of get into when we started seeing some of these pressures come on. And moreover, not to beat up the deal so much, but really to give insight on what an operator experiences when they're navigating in a fiduciary role for their investors, right? Like you said, I opened up the portfolio and now it's red. Like, we're not going to sell. Everything's sound. The fundamentals are sound. We need to put ourselves in a position to navigate and get more time. So Danny, what are some of what did you and the team start doing? Like, did you have a brainstorming session? Like, what were probably the top 2 or 3 things that you started diving into in order to get this property stabilized and buy more time?
Yeah. Really it's reevaluating what the economic fundamentals for that market are and that specific kind of comp set around the property. So, we're not really concerned with the national apartment industry. We're not really concerned with the Southeast US apartment industry. I'm not even as concerned about the Savannah apartment market. I am very concerned about my little neighborhood in Savannah and what that demographic profile looks like from a resident base. And so, you know, we check that, we verified that. The fundamentals are there. Over the last 2.5 years, the property has had excellent occupancy, like 95%. It might be even higher on average, but super strong occupancy, very high monthly collections. That leads me to believe we have an excellent resident base. So then we started to look at, hey, what happened? Why did we, see kind of flat rents across the portfolio? And, the reason we concluded is just from the added supply within our little neighborhood. And that supply has since been stabilized. And so we will start to see some of the concessions that we had to give up, some of the promotions or your first month free type of deals go away now that the supply is absorbed. And very, very soon, we're going to see a flip in the multifamily market specifically, where there's going to be more demand than supply. And we are going to have a lot of good organic rent growth when the demand outweighs the supply. So we kind of had that supply issue. It kept our rents flat. We had to give up income in order to maintain our occupancy, which we ultimately wanted to have. And, second to that, during that whole time period, inflation was occurring. We saw payroll increases. we were unable to pass these increases on to our customer, our resident, because of the competition in the submarket. And so, with inflation going up, utility costs going up, insurance premiums going up, taxes going up, I'm sure I'm missing other services, software fees, licensing fees. Everybody kind of passed on the inflation to the customer. And so when we were the customer, who did we pass our increases on to? No one, because the market didn't allow us to just increase rents because our expenses got a little bit higher. And so, we did our best to manage and save and cut where we can. But that was the first big thing of like, hey, did we make the wrong decision in buying this asset? Were our fundamentals wrong? And at the end of the day, no, they weren't. Real estate, I don't think is one of those investments where you buy it day one and every month in perpetuity, do you get a positive, positive cash flow every single month. It's just not going to happen. So there's ups and downs to it. I think we had, way more downs over the last 2 years than we had good positive things that happen. But those positive things are coming to the market. Our fundamentals are strong. More people are moving to Savannah. More jobs are coming to Savannah. We have a great resident profile. We will be able to start increasing rents organically, and we have this value add opportunity. So when we saw the supply coming and we saw the softer kind of market, we said, hey, we're not going to spend any money on these value add projects just yet. We need to make sure that our finances are in order first. We need to preserve as much cash and reserves as we possibly can. And now that we're past that point, we can start to implement that. We feel, good about where the market is going. Is it going to be great tomorrow? No, but over the next, 12 to 24 months, I think we'll be in a great spot. And so we can slowly start to do those things. And, that's kind of the couple of things we looked at: market fundamentals, where the property was at, supply, what opportunities we had. And then, the last thing is just, as you kind of mentioned, it's either, are you willing to do the hard work during the hard times, or are you, folding and quitting because you're scared? And, I certainly had nights where I lost sleep about thinking about these things. And, at the end of the day, we are all investors together within these deals. And, we have a great investor base, and people understand that, things go poorly. There's things outside of everyone's control, and we have to work together to get there. And at the end of the day, if you believe in the fundamentals of the investment and the fundamentals of what real estate are, I think that's what carries you through these hard times. If you look back to 07 and 08, really hard times, those people who, held through into 2009, 2010 started to profit. And it was a crazy bull run for real estate over the last decade and a half for the most part. So again, I think that's important to take into account. And then probably the last thing on that, that question was, what else did you look at? And the biggest thing that you have to look at is capitalization. As an operator, do you have capital to put into these deals? And then number two, how strong is your investor base to contribute capital when it's needed in the hard times? And thankfully for us, the answer to those two questions was a great amount of capital. And I think that's probably where some operators got into trouble if they, personally tried to put a deal together and didn't have their own personal money for reserves and putting extra money in as needed, that's kind of where you get caught. I always think about Charlie Munger and Warren Buffett. I forget how much cash they sit on today, but I think it's like $4 billion in cash. That's a good rainy day fund. I'd like to get there. But you need resources to go to battle, and a huge reserve of dollars is in real estate. It's how you're going to win every single battle. So it's not a hard formula to figure out. So thankfully, we have a great, between myself and Dan, we have a great source of capital for the two of us, but then we have a phenomenal investor base that also, contributes in hard times and understands and believes in the fundamentals, believes in the investment, and you got to move forward. And so it's a great lesson to learn. And it's one of those things that kept on resonating with me, of just, Buffett and Munger having this crazy volume of cash just for a rainy day opportunity.
Yeah, one of our listeners chimed in the chat. Yes, please, $4 billion. I would love that check. But I want to bring it back to kind of like the tactics, right? Like, again, kind of getting the peek behind the curtain, right? So we have an asset, amazing, really good fundamentals. We double check everything, everything's solid. We're getting all these expense increases being passed through to us as the operator, but we can't pass it through to the tenant. Okay, so, but we're trying to keep as many tenants in place as possible to keep the income as high as possible, right? Because you brought it back to the name of the game here is not to have to sell in a down market. So we need time. Now you've kind of gone the 30,000-foot view, but I want to go kind of like an inch wide and a mile deep. Right. So we talked about capitalization, and it's capitalization, how deep are the partners' pockets, how much money can the limited partners bring in the table in a time of need. But let's also talk about how this worked between approaching the bank and then how did that process all work with the workout? And then, when we got to the end, then what did we do after that to fill in the gap?
Yeah, I mean, basically, any lender out there will do their own independent valuation, especially with our property types and sizes, right? We have institutional quality lenders that we work with. They have their own investment committee and board and process. And so, um, they are a good double check to our belief. If they didn't believe in the property, they would probably just say, hey, we're not going to extend the loan any further. And their willingness to work with us is a positive sign that there is a good underlying value in this asset, and it should continue to be held. And we're okay extending, 60 some $1 million for a couple more years, in order for you to execute on your business plan. And so that's a great win. And then it's a back and forth of, trying to negotiate out some terms for us. I felt like having more time was more important than bringing the least amount of equity to work out a deal with them. And so I was much more interested. 12 months goes by really, really fast in the real estate world, or just in general. So 12 months, I don't think would have gotten us to a new economic climate, but I feel like 2 years will get us, you know, through 2025. We'll see what happens. I think, if the Fed does what they say they have planned, then things will change, and we will see where we're at that point in time. And so, you got to figure out what your maybe 2 or 3 important issues are, and then, go and fight for those things.
I love that. And that's a great point, is it's not all about, getting the cheapest terms possible, right? It's about what is it that you truly need, in this case, time, and then negotiating based on that, right? If time is what we needed, right? Like the bank would have given us a deal for 12 months, but then, if
Yeah,
you can't see the path in 12 months, or if we already know up front we need longer, like, let's negotiate on the 24 months or whatever that time schedule is. So that is
that's right.
a very clear point, that limited partners, should take to heart whenever they're looking at some of these deals. Now, negotiating with the bank wasn't the only thing that we did to turn this project around. What were some other things that we did from a capitalization standpoint?
You really have to consider every possibility out there. So, refinancing into a fixed rate agency loan, absolute possible outcome. Um, with where interest rates are at and um, lending requirements, or how agency loans are DSCR constrained. Um, Doing a refi, you would have probably needed 15 or $20 million of equity, cash in equity, to make the numbers work. And, that was certainly an option. And then you just need to weigh those options. So refining 15 to $20 million cash in, that's a big chunk of money. Option two, maybe you refi or do an extension and you utilize some institutional pref equity. That can be reasonably priced. It's not like you're going to get a cheap and very affordable um, pref equity cost of capital. So it could be fair market priced. There's certainly some groups that will gouge the heck out of a borrower or a partner, to utilize their funds. And so that was one thing. The biggest downside, to some of the institutional pref equity is losing control of when to buy and sell. So I've heard of a few deals out there where they, maybe a year or two ago, completed a deal, had pref equity, but the pref equity was adamant about selling right now today because the pref group could get their money and their capital returned. But then all limited partners and the general partner operator were all wiped out. And the pref group doesn't care because they're not invested in those positions. They're in the preferred equity position. And so, for someone like me, our group is just a little bit old school. We've never worked with an institutional investor. We really have no interest in exploring that. We don't want to give up any control. Making the decisions for us as limited partners alongside all of our LPs, I think, is again one of the most important things. And so that, the refi option, super equity dependent, huge equity contribution for investors, probably not realistic at that point in time. Pref equity, too many downsides, when kind of option three is utilize our investors, in the deal and outside of the deal, to raise the money that was needed to fulfill the deal equity need. And so, within option three, you can look at doing a capital call, you can look at structuring a note. And for this deal, for this particular structure and need, we felt that a note was best. And it worked out really well for us to do that and, fulfill the capital need that the deal, required, and allowed us, ultimately the whole goal was how do we extend for a couple more years, as opposed to being short on cash and being in a position where you just need to exit early. And so it was a great win, and you know, a kind of tough decision, but a fairly simple direction. Once you put some numbers on paper and you're like, hey, refi and having a massive cash in, not good for all investors at this point in time. Pref equity, market's a little too up and down, and we don't want to give up when we need to sell. That's probably not a good option. Structuring the funds from our own investor base, having the control to sell or refi whenever the market is better, much better outcome and less equity compared to a refi.
Now, I think that brings up a really, interesting point because, we're not the only operator that has utilized a note in, a subordinate position or, what's commonly referred to as a promissory note. And I think there's because of that, some of them have gone well, some of them have not gone well. There's a bit of a stigma here. So how does a limited partner investor, when they hear the word promissory note, how are they to figure out for themselves if this is a good opportunity, or it's kind of like, oh, the operator's just doing this because they need a capital call, and it's really throwing back, which even doing a capital call is not necessarily bad, right? Like it all goes
Yeah.
down to the
Yeah.
asset. Now I'm spoiled it for you guys. I accidentally jumped ahead and gave part of the answer. But anyways,
Yeah.
Dean, I'm gonna ask you because I want to know your
Yeah.
opinion. How does a limited partner think through their decision tree?
Yeah. Well, I always think back to, what is the best use of dollars? And so, um, risk versus reward, is kind of how I mentally work through any investment opportunity. Because at the end of the day, you know, it's another investment opportunity. You have to think through that. And so, step one that I think about is, what is the risk to the the note, or what is the risk to the investment? And in this particular example, the deal has, from a capital structure, a senior lender. The senior lender will get paid off first, then the note gets paid off, and then the investors get paid off. And so, knowing that structure, I then look at, okay, what's the value of the asset, and how much would the value of the asset need to decrease today in order for my note money to be at risk? And, if you're sitting in a good leverage position, like a LTV position, I would think about it as a lender. Like, what's your LTV position? Um, that risk is pretty low. You would need the asset value to drop significantly in today's market, um, in order for that money to be at risk. And so then the answer is, okay, I'm in this low risk position. I'm making, what is my return on investment? And does it match my risk level? And for me, the answer is yes, it does. It's a good investment with a limited amount of risk and a good and fair market return. So that kind of checks out on my first um, method to compare one investment opportunity versus another investment opportunity. So that's kind of the logic, the risk return logic that I use. The riskier the deal, the riskier the opportunity, the higher return you need. And so, you know, for my position, I don't really need to go after super high risk deals. I think protection of existing capital is much more important than, trying to chase a 30 or even a, 20% annualized return deal. I'm very comfortable if I know what the risks are and I know what the return is, and I'm in a healthy range, that feels really good to me. And so that's kind of how I utilize that decision tree to that extent. And then, the second piece that comes into it is what alternative investments are available to me at this time. And in today's market, there's not a whole lot. Um, there's there's a few differing options out there. And I think any investor needs to go through that logic of what's the opportunity cost. If I put my money over here, am I losing out on something over here? And then the third piece that I think through is, you know, am I utilizing these funds for the benefit in protecting other investments? And, that's another factor to consider when you're already an investor in a deal and you might be participating in a capital call or in a note. It's important to measure, you know, what your commitment is to your existing investment or that existing opportunity, and do the basic fundamentals make sense for you to continue to do that. And again, I was really thinking about this over the weekend quite a bit about, you know, stock investors, right? They buy a stock at $100 a share and it gets hammered and it goes down to $70 a share. Most people get emotionally charged and will sell and sell at a loss. And then some people make the decision to say, hey, I did my due diligence. It's a good fundamental investment. There's some weird things going on in the market that are outside of my control, but I could come in and buy at $70 a share. And now I'm dollar cost averaged at $85 a share. And so I think that's another perspective to think about in real estate, because over the last decade and a half, we haven't really seen some of the challenges that we've experienced in the last 2 years. And so I think it's important to kind of bring that dollar cost averaging um, methodology into consideration. Not that it's like the end all be all, but it's something to think about with an investor. If you buy a stock for 100 and it goes to 70, what are you going to do? Because you log in and there's red all over the screen. Are you going to, sell it and lose 30%? Or do you buy it and dollar cost average and you understand the fundamentals of the investment are quality, and you're going to stay committed to it? So that's kind of the three-pronged approach that I personally take, just to think about, what's the risk versus the return? What's my opportunity cost of capital? And then number three, what other pros and cons are there to making the decision?
Well, Danny, thank you so much for that insight. We've covered a lot of ground today as far as, Mariner Grove, just peeling back the curtain a little bit, giving our limited partners a bit of the story and insight on, how an operator looks at the deal. What are they looking at in order to get it restabilized and turned around and back to profitability? We tapped into promissory notes and where that aligns into one of the solutions that can be implemented for recapitalization. And then, guys, rewind that last 5 minutes because if you're faced with, or if you're looking at an investment decision, maybe you're looking to invest in a promissory note. Or maybe you're already in a deal that's putting a promissory note or a capital call in front of you. The decision tree that Danny just gave is just completely priceless. Now, Danny, I want to thank you so much for spending your time with us here today, your knowledge and expertise. Guys, if you're here live, don't go anywhere. We're going to start our Ask Me Anything part of the show.